Gives me great pleasure in introducing two people who are going to be speaking in the fireside chat, Mr. Vaidyanathan and Dr. Nachiket Mor. I have immensely admired both of them, learnt a lot from them. They're like mentors. Mr. Vaidyanathan, or Vaidya as he's fondly called, secured a seat on the board of ICICI, built a retail empire of 1,400 branches and over $1 trillion in deposits. In 2010, he chose to walk away, buy a stake in a tiny NBFC by pledging his own home, grew it into Capital First, and merged it with IDFC Bank to build one of India's modern banks, IDFC First Bank. And Dr. Nachiket Mor, the legendary KV Kamath, recruited him to ICICI, rose to Deputy Managing Director, founded the ICICI Foundation for Inclusive Growth, followed by Sugavaiva, bringing healthcare to villages, and then moved to the Reserve Bank of India. He was appointed to chair the committee that shapes much of India's financial inclusion today, and he also served as the National Director of Bill and Melinda Gates Foundation. Nachiket designs health systems today, visiting professor at ISB, commissioner on the Lancet Commission on Reimagining India's Health, and chairman of Care India. And on that count, let's give Dr. Nachiket Mor and Mr. Vaidyanathan a big applause.
It is really a great pleasure and privilege for me to be with Nachiket Mor this morning. And we're together, two of you are going to try to bring some thoughts and insights for all of you.
Well, I'm very pleased to be talking to Vaidyanathan, old colleague of mine from ICICI, a bright spark from what I know of him in the past, and from whatever I've been hearing about his work. He's really done quite remarkable work, and I'm pleased to be able to talk to him.
Hey, thank you so much, Nachiket. So I'd like to actually take you back, a little back in time, since I have had the privilege of knowing you from the, let me say, early 2000s, and talk about how, let me say, 2005, 8, 10 was on inclusion and what efforts probably even you had done, one or two at that point of time.
Well, classic Vaidyanathan style. I am the anchor, he's the speaker, but he wants me to begin the journey. I'm happy to do it, financial inclusion, and all of you know this better than anybody else, has really seen a mega transformation over the last 25 years. We'll debate, is it enough? Is there a lot more that needs to be done? And that's an important question. But, when we started earlier, the real idea that anybody had financial inclusion was bank nationalization. Bank nationalization, the principal reason argued was financial inclusion, that the private sector was not interested in doing anything on the on this front, and that government needed to do it. And that's really the model that we had. This idea that the private sector could play a role, this idea that banks could do financial services outside bank branches. Electronics was not such a big deal at that point. I remember when ICICI started internet banking, I think at that point, the regulator took the view that every internet account was a regulated branch, and therefore a license had to be sought for it. I mean, nobody knew what this animal was. Even ATMs were a new entity then. And I think since then, a lot of progress has happened. We have, Secretary mentioned business correspondents, important milestone in that area, the whole digitization that has happened, and certainly the role of the microfinance institutions we always knew about self-help groups, we always knew about the power of women, and people like Vijay Mahajan, had built out this structure. But the industry had remained, I remember 2001, 2002, 200-300 crores. Even in those times, that was nothing. I mean, in today's times, that might even seem like your daily loose change, as it were. But at that time also, it was not that much.
So, take me through the story about how Feno was conceptualized by you in that context.
The issue was, as a group in ICICI, as you know, you also worked with ICICI, we were empowered to think about ideas that seemed to fill gaps that were there. I was telling you about the business correspondent story. One of our colleagues saw a Time magazine article on President Lula, and Sir mentioned the Latin American model. went to Brazil, looked at what they had done, and there was a long journey to actually bring the business correspondent out. Similarly, the concern was that the whole idea of electronics, both in managing MFIs, but also this new ID of what
So, but that time there were no IDs, there were no,
There were no IDs.
UIDAI. So,
not
how did
possible to do.
Feno fill in that place, and what was the thought behind that?
So the idea that, and Manish Khera, Rishi, these were the people that, again, ICICI people that decided that this is what, and we said we would float this company off as an independent company rather than keep it in ICICI, started issuing smart cards with biometric authentication. And in fact, Andhra government was one of the first governments to take this on to do NREGS. And several million cards were issued in order to ensure, because the problem was there was a lot of leakage of people who said that they were supposed to get the money and the people who actually got the money.
So this was your own, our own, let me say, before the arrival of UIDI, unique identity, this was own private enterprise effort of creating an identity and piping money through that.
It was, and I would say that it gave everybody confidence that this kind of approach would work. I think Feno went up to, I don't remember the numbers now, but maybe 50, 70 million cards. So it was a large effort that showed that you could actually do something like this.
So Feno gave identity, Feno maybe created even a pipe for being able to do some sort of a services. So on the credit front, you came with the concept of white spaces way back then. What was the concept of no white spaces concept, and what did you go about it?
So, obviously we have to turn to you because you are the person that people want to hear from at some point. But yes, we discovered two things, that there were two problems that we needed to solve. One was that there were local institutions that knew a great deal about what is going on the ground, but they were not financed well. They had the knowledge and the information, but they were not financed well. Similarly, there were individuals on the ground that were actually knew the local environment much better, but they were not being used as channels. Bankers were going in from the outside and trying to collect information about somebody on the ground. So what we did is launched, two specific ideas. One was the partnership model for MFIs, and the other is what we call credit franchisees, in which effectively what we did is created some form of a first loss structure that ensured that the person giving us information had their skin in the game.
So the franchisees were keeping some money on the table, which became the first loss.
They gave us a deposit.
And they would do the lending.
Yeah. But what I found fascinating, and I want to turn to you for a minute, is what you have done with something like this. Is so far, the journeys that we had done, they have taken us some distance. But it's something that I think it's obvious to us, that credit to GDP ratio, if you look at India, in aggregate, the number has jumped
60%.
From about 50, 60% to about 80, 90%. But if I go back to Bihar and ask the question, what is the credit to GDP ratio? I was just looking at the numbers, it's still 30%. In order for an economy of the size of Bihar to grow, it needs to be 230%. Right? It's an enormous gap in the system. And of course, while we have made good progress on EPI, cash to GDP ratio also remains 10 to 11%. If anything, it has gone up a little bit since I was actively involved in years. What you have done, and I think that's a remarkable story that I think people would benefit from hearing, is you've taken not the microfinance, self-help group, MFI, that story, but the SME story. And you've gone about it in a very unique manner, both using information of the type that we did in franchisees, but now adding technology, adding your own unique insight as a retail banker. Very keen to hear from you.
So what we did was we identified a sector like Kirana, auto mechanics as one sector, restaurants as a sector. And for each of these, we went deep. We didn't have one MSME scorecard, we developed 22 MSME scorecards. And I'll give you one example, give you an idea. So if you go and give to a restaurant, so we went to restaurants, they said we need more space because more customers are coming. So how do you evaluate one restaurant from the other? So we went and we discovered a very small hack. We said that, show me a size of give me your menu card. So you just take a very simple maths. You take the menu card, total up all the sum total menu card, divide by the number of items, you find the average bill size. Okay? And then you do this for a Kamath restaurant versus a Raghav restaurant versus a five-star hotel, you will find there's a distinct differentiation between that. So that became one data point. So like that, we gave close to about, let me say, 20,000 loans. We took all the data from these 20,000. This is pure greenfield research. And from those 20,000 loans, we gleaned out all the necessary insights from that. We called them, because startups, we didn't have money. So we called them kids from IIT, from Bombay and all. We got them to do some scorecard work for us. And then they took out a formula out of that. And then we took the formula out of that, and then we scaled it up like funding restaurants. Then we scaled up funding auto mechanics. We scaled up financing chemists, dairy, cattle, goats, cows.
And where did AI come into this? Because you
So
were saying,
AI came,
the next level after the IIT boys.
So that came, so this gave us the first maybe 20,000 loans. And then along the way, before AI actually, digitization came. So AI just came, maybe the generative AI has come now, maybe some years ago, but digitization came. So digitization actually dramatically changed the game because this entire UPI and the ecosystem and the Aadhaar and PAN and the bureaus and all that. Then that was a big moment. Then we took all the formula, we made a model out of it, and then started giving the next lending. And then we gave, we had put out close to 3 million loans. Our loan book grew from 100 crores in 2010 to 7 million customers in 2018 with about 35,000 crores. And the same book today, lending in these segments, of course, now we become a bank, we started lower cost of fund, we do more safer segment, but the concept is the same, has now touched 2,10,000 crores. So it's a 100 crore idea, now becoming 2 lakh crores, all in the space actually.
One of the points whether you had mentioned, which I thought was quite fascinating, is that your high cost of funds, in a way, was an advantage to you. Because maybe had you started as a bank, or you were a large bank already with 6% cost of funds versus 13% cost of funds, the journey you would have taken would not have brought you where you are today.
100%. We can comment these things in hindsight, but obviously you're not feeling a joy raising money at 11%, 13%. We're trying to reduce it. But yeah, because we're borrowing at 13, we have to figure out this model. It is an ecosystem thing. If you see, everything in the country is unorganized. Right? It's less organized, getting better. But if you see the, we talked about finance sector, we talked of the employment sector. In the health sector, we have the Narayanas and we have Apollos, we have everything. But if you see that as a percentage of the doctors you're serving, on the roads and you're working in health yourself, that's very, very high. If you see education sector, we have Dhirubhai Ambani schools. But how many? Majority is still running, even private sector schools are running unorganized. So this thing about India's migration from being the unorganized sector with the benefit of digitization, technology, payment systems, inventorization systems, the stack, migrating it from unorganized to organized is the biggest breakthrough we are going to experience.
No, that's wonderful for you to hear you say, because as the secretary also mentioned, a state like Arunachal, in fact, the committee that I chaired for Reserve Bank of India, we picked 2 districts in India. Pathanamthitta in Kerala, 100% credit to GDP ratio, 100% inclusion. Arunachal Pradesh, Kurunkume, 1% credit to GDP ratio. Right? How do we get this country of ours to 200% credit to GDP ratio? In a sustained, because so far we've been pumping microfinance, pumping group loans, not a bad thing to do, wonderful thing to do. But it's not producing the kind of job-oriented growth that your models, when you're funding a restaurant, when you're funding a shop, when you're funding a salon, these are all job creators.
So can you take us through the story about how warehouse financing started? What are the challenges you faced in that? Way back, you once told me a story of how, some warehouse happened, potatoes happened, something like that.
I mean, one of the ideas, and unfortunately it's an idea that has not yet fully taken off to the degree that I had hoped, is that farmers are not getting the products and services that they need. While Secretary mentioned risk management, India is one of the few countries that does not allow farmers to buy derivatives. Right? It's just banned. For what reason, it's not completely clear, but it is banned. Right? Warehousing is another area where farmers have an advantage. Right? If I've got a stock of wheat of 100 crores or 50 lakhs or 2 lakhs, that is effectively AAA credit, right? Collateral, because I can sell it in the market. And early days, to just give you that story that you mentioned, we didn't fully understand all the local mandi logistics. So we ended up financing in West Bengal 80% of the potato stock in a local mandi. Now what we didn't realize, that if I have 80% of the stock, it has no liquidity. The minute I try to sell it, the market will collapse on me. The potato owner knew this, so he happily defaulted to me. And he said, you do what you want. He realized I have to negotiate with him because he's the only buyer that can come forward. But you know, these are early days. We had hoped by now there'd be a full demat trading.
So did you lose money on that trade?
Yes, definitely.
So then how did you unwind that thing from that point of time?
I mean, at the end of the day, we had to negotiate with the guy.
And
he was right. There was no alternative that we had.
So now the market mechanism on this is much improved. The tech stack is much improved.
It has improved, but we don't have a spot market yet. India is one of the few countries that does not have a national electronic spot market for commodities. We still have a journey to go in that direction.
But you know, one of the areas, you know, talking about this space that I still find a very big opportunity is about you know, skill financing. Because I talked of entrepreneurs, but skills. If someone is taking an education loan, they can't pay back. There's no business out there. They need a lead time. They take a lead time to learn and they pay. That becomes a second track, not a business financing we talked about. It's not consumer financing we talked about. There or somebody, for example, we are financing, say, beauticians. We are financing, say, you know, they learn the trade and they will subsequently implement it. So that becomes another opportunity we haven't talked about, maybe, you know, some other day. Another big one that we are seeing again is...
On that issue though, you know, with the spirit of what the government can do, in medicine and in many of these professions, around the world, there is what they call income contingent lending, where you may lend the money, but the repayment happens via the tax system. You know, if your income crosses a certain number, the government deducts somewhere near 10% of your income above the minimum and uses that to repay the loans that you took. Which means, of course, if you serve the poor and you don't have enough income, you don't pay. But if you cross and you start working at a super specialist in a large hospital, you actually end up paying quite a bit. It's an interesting model.
Okay, that's interesting. I'd like to take your comment on one more thing and tell me how. The other one that's now opening up in a significant way is cattle. I'll just tell you our numbers. We have financed close to 1 million cattle loans. Who would believe this? And we had to do this because we had made priority sector initially, but frankly, it's not just priority sector. I just love it as a business as well. So microfinance, typically about 60-70% of them are sometimes can be cattle. But we also do individual cattle loans. Like go to an entrepreneur, they say, I want to buy 2 goats of 300, whatever, buffalo, and we finance that. So that is different than a micro entrepreneur business like agarbatti and all that. This is like a cattle because there's somebody's producing milk and paying you back. That segment, have you seen the evolution? Have you seen change in it? Or have you attempted it at all?
No, there are. We did not get into it when I was there, but I've seen now, I know Dwara has a whole capability to identify using a, you know, a face print. Which, because earlier it was these, you know, ear tags. Then you started finding many cattle with no ears.
I know.
Because ear tags started to disappear. So this has become a new mechanism to identify. Of course, there are deeper problems. You know, for example, Indian cattle don't have the yield that is necessary. We don't have the breeds that we need. And you know, if you're getting into the whole cattle financing, you may want to start thinking about, just like when ICICI got into warehouse financing or commodity agriculture financing, we started to build NCDEX, we started to support building warehousing companies. Maybe something like this you could do to build out the whole cattle ecosystem.
All of these, you know, require some kind of a risk appetite. And when you're a bank, we are taking public money and public. You have to be very careful with the money because at the end of the day, there are public benchmarks of how much gross NPA, net NPA, and credit cost. But in the way I look at many of these things, often I think of credit cost as research and development expenses. This is the way I think. I tell people that don't get tense about 2% credit cost. This R&D expenses. Because as a nation, we say we don't invest in R&D. Manufacturing, steel, we always say behind China. In financial sector, I treat credit cost as research and development expenses.
It's a very nice perspective. Very nice perspective.
And it is...
No, but what is very inspiring, Vaidya, and I'm so glad that we had a chance to talk before and now, is that as a mainstream bank, you started life working with as it were, the bottom of the pyramid, as it were, the SME. Now you've become a mainstream bank. It's very easy for you to say, that was then. I'm going to focus on housing finance now. I'm going to focus on credit card. You're a master of these things. You've built these markets. But you've stayed with this segment. And you have really built up this segment as you go forward. And I hope many more banks see this as an opportunity of the type you have. And what I was pleased to hear is you don't regard any of this as private IP. You're happy to share with people what you have done. How have you gone about doing it? I would love to see a time when you're doing 10 lakh, 20 lakh, 30 lakh crores instead of 1 lakh crore to really reshape these markets. Because I certainly believe that unless we worry about this in states like Bihar, UP, Arunachal, we are not going to get the kind of balanced growth that we need.
No, thank you for that. I appreciate that. Actually, we've got to draw the balance here because you're a bank and, bank has risk metrics and you've got to raise public deposits, you've got to raise equity from the markets and all that. But, to balance the two, I do like the DNA that we created and not let go of the DNA, but within the norms of a bank. Okay, thank you very much. Thanks, Nachiket, speaking to all of you. Thank you.